In this video, I'm going to discuss the tax consequences when an S corporation makes a distribution of non-cash property to one of its shareholders. Now, those tax consequences are going to differ based on whether the S corp is distributing appreciated property or property that has gone down in value. Okay, so we need to look at the fair market value of the property that's being distributed to the shareholder and compare that to the basis of the property. If the fair market value is higher than the basis of the property, we say that that is appreciated property, and it's going to be treated as if the S corporation had actually sold that property to the shareholder for its fair market value. There's going to be a gain recognized on that sale, and each shareholder of the S corporation is going to be allocated a pro rata portion of that gain. And whether that gain is going to be a capital gain, whether it's going to be ordinary income, that's going to depend on the type of asset that's being distributed to the shareholder. Now, each shareholder's basis, okay, so even the shareholders who aren't receiving any property, each shareholder's basis is going to be increased by their pro rata share of the gain. Now, the basis of the shareholder that's receiving the property, their basis is going to decrease in it. So it's obviously going to be increased by their share of the gain, just like every other shareholder, but it's also going to be decreased by the fair market value of the property that they're receiving. Now, if the fair market value of the property being distributed to the shareholder happens to be less than the basis of the property that's being distributed, in that case, we call it lost property. You can call it depreciated property. Okay, so basically, let's say with the fair market value is $20,000, and then the basis of the property is $50,000. Normally, you'd think, well, hey, if we're going to treat this as a sale, there would be a $30,000 loss here, but there is not going to be any loss realized. So the shareholders aren't each going to get their pro rata share of a loss. There's not going to be any loss at the corporate level. We're not going to have a $30,000 loss in this situation. However, each shareholder's basis is going to be reduced by their pro rata share of the non-deductible loss. So that's bad for the shareholders in that you don't get to recognize this loss and get a tax deduction for that. However, your basis is coming down regardless. Even so, you didn't get to deduct your share of the loss, but your share of that non-deductible loss is going to reduce your basis. And then the shareholder who actually receives the property, their basis is in addition to the pro rata share of the non-deductible loss, reducing their basis. In addition to that, their basis is going to be decreased by the fair market value of the property that they are receiving. Okay. Now notice that in both situations here, we have the shareholder taking a fair market value basis in the property they're receiving. If they're receiving inventory, land, a building, whatever from this S corporation, they're going to take a fair market value basis. And now you can see that obviously it's a really bad outcome when the corporation distributes lost property because you don't get to recognize that loss. And so what you really want ideally is if the S corporation has property where the fair market value is less than the basis of the property, it'd be better for the S corporation to just sell the property, take the loss, sell it to an unrelated party, take the loss, and then you'd have a deductible loss, and then take the proceeds and then distribute the cash proceeds from selling the property to an unrelated party to the shareholders. Okay, so, but in any event, let's get into the specifics of an example, actually how this would work. So in the first example, I'm going to do a situation where the fair market value of the property exceeds the basis of the property. So we've got an S corporation here, and they're distributing land to one of the shareholders, and that land has a basis of $100,000, fair market value of $900,000. So this is an example of appreciated property being distributed to the shareholder, and I want to go through all the mechanics so you understand exactly how this would be accounted for. Now, let's assume this land is a capital asset. Also, let's assume the shareholder, Rachel, is a 50% shareholder. So she owns 50% of this S corporation. Okay. Now, prior to this distribution, prior to the S corp giving Rachel land, we've got the accumulated adjustments account had a balance of $5.3 million. We have an accumulated earnings and profits account from back when the S corp, prior to it electing to be an S corp, back when it was a C corp, balance of $425,000, and then Rachel's stock basis prior to the distribution, $800,000. So these are just the basic facts. Now we're going to talk about how this distribution will be accounted for. Remember, it's treated as if the corporation actually sold the land to Rachel. So there's going to be a gain here, difference between $900,000 and $100,000. We got $800,000 gain. Now, because that's a capital asset, we had said, this can be a capital gain. So we're going to have a capital gain that's going to be triggered. Now, that capital gain is going to be passed through to the shareholders of the S Corp, not just Rachel, right? Now, Rachel's a 50% shareholder, so she's going to get $400,000 of that capital gain is going to be allocated to her. So Rachel's going to have $400,000 of the capital gain allocated to her. The other $400,000 is going to be allocated to the other shareholders based on their pro rata stock ownership. Now, so Rachel is going to have some tax consequences here, right, for her share of that gain that was triggered when the corporation distributed the property to her. Now, Rachel's stock basis is going to decrease by the fair market value of the land that she's receiving, which is $900,000. So let me scroll down a little bit here so you can see that, and increase by her share of the gain. So her initial stock basis we said was $800,000. That was just given. So she started at $800,000 basis in the stock plus her share of the gain, which was 50% of $800,000. So we're going to add $400,000 and then subtract $900,000 the fair market value of the property she's receiving. So her new stock basis, that's the basis in her S Corp shares, is going to be $300,000 after the distribution, after we've accounted for all this, allocating the gain to her and so forth. Okay. Now, what is her basis going to be in the land? Because remember, she received some property here from the S Corp. It's going to be its fair market value, which in this case is $900,000. Now, the accumulated adjustments account, what's going to be the new balance there? So let's say, originally we said that the accumulated adjustments account had an initial balance of $5.3 million. So we've got $5.3 million as the initial balance, plus the entire capital gain of $800,000. That is going to increase this AAA account, right? The accumulated adjustments account is going to go up because of this capital gain, this income. And then it's going to go down because the fair market value of the property being distributed $900,000. So we got $5.3 million plus the gain minus the fair value of the property. We end up at new accumulated adjustments account balance, right? $5.2 million. Okay. So it started at $5.3 million, went down to $5.2 million. Now, next scenario, I'm gonna just change the facts a little bit. We had said in the example we just did, where the fair market value had been $900,000 and the basis of the land in the corporation's hands was $100,000. So we had an appreciated property, right? Fair value was $900,000, basis was $100,000, so we had $800,000 gain. What if the fair market value of the land was just $30,000 when it was distributed to Rachel? So now we're going to assume still a basis of $100,000, but now the fair market value of the land is just $30,000. So we have a loss situation with $70,000 loss. Now, we have that $70,000 loss, but remember, when you distribute property, non-cash property to a shareholder, you are not going to recognize this loss. So basically, Rachel is not going to get to deduct half of that loss. She's not going to get a tax deduction for that. Okay, so the loss is not going to be recognized. What the corporation should have done was they should have sold the land to an unrelated party, took a loss, and then gave Rachel cash. But in any event, that's not what they did here. So let's talk about how they'd account for it. So her stock basis is going to decrease by the fair market value of the land that she's receiving, and also her share of the disallowed loss. Okay, so we've got $800,000 initial stock basis minus her share of the disallowed loss, which is 50% of $70,000. Even though she didn't get a deduction for her share of the loss, it's still going to affect her basis. So $800,000 minus $35,000, which is 50% of $70,000, minus the fair market value of the property she's receiving, we end up with a new stock basis. This is Rachel's basis in her S Corp shares, $735,000. Now, Rachel's basis in the land is going to be the exact same as when we had the appreciated property scenario. It's going to be the fair market value. So whether it's lost property or appreciated property, the shareholder's basis in the property they're receiving is just going to be the fair market value of that property. So now the accumulated adjustments account, let's talk about that balance. Okay. So the accumulated adjustments account, initially we had said in our example before the fact pattern, we said $5.3 million was the initial balance. Well, now we're going to subtract the non-deductible loss, the full $70,000, right? Even though the shareholders did not get the deduction for that, that is going to affect the accumulated adjustments account. So we got $5.3 million minus $70,000 minus the fair market value of the property that is being distributed, $30,000. So our new accumulated adjustments account balance is going to be $5.2 million. Now, again, note that this was a really bad outcome for the shareholder, Rachel, because she's getting a step down in basis of, so this land, the basis in the hands of the corporation was 100, but now in Rachel's hands is 30,000. So the basis got stepped down when the land went from the S corp to Rachel. The basis went down to 30,000, but Rachel did not get to deduct a loss, right? So again, what should have happened here, better tax planning, is the S corporation had, instead of giving the land to Rachel, if it instead sold the land to an unrelated party, recognized a $70,000 loss. Okay, then every shareholder, so then Rachel would get 50% of that loss. The other shareholders would get the other 50%. And then just take the money that they got from selling the land and then just make a cash distribution to Rachel. That would have avoided this scenario where we have a $70,000 loss that is not deductible.